It's really confusing actually when you think of all the acronyms when you're thinking about investing and all the different fees that are associated, because you might not be thinking about everything that's linked to the cost of owning an asset, right? If two people who work in the industry cannot find the fees, how do you think the average person is going to understand that?
The Get Rich Slow Club podcast is a collaboration between Tash Etchman from Tash Invest and Anna Christina from Perla. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you.
Welcome to the Get Rich Slow Club podcast,
where we take you from beginner to confident investor,
where we can teach you everything you need to know about investing.
So come get rich slow with us. Hello, welcome back. In this week's episode, we're going to compare ETFs to LICs, which is a topic that was very hot a little while ago, but surfaces every once in a while. So we're going to actually tackle it today in this episode. For those who are new to those acronyms, ETFs are exchange-traded funds and LICs are listed investment companies. But before we dive into this topic, let's chat our money wins and losses as we always do. Tash, what's yours?
Webjet is so underrated. I saw someone post a story about them recently. They had $100 off flights to Perth.
Whoa, that's a lot.
And so the Jetstar flight started from $106 from Melbourne to Perth, which is crazy. Yeah. And then they also add on like a $35 Webjet booking fee. But still, I booked a flight because I didn't want to go with Jetstar at midnight. I went with Virgin at like 6 p.m. or something. So my flight was $185 plus the booking fee, which is amazing. Because if I went direct through Virgin, it was going to be like $300.
That means it's affordable for me to go see the Quackers.
Yes, $2 return if you fly at an awkward time. You might like it because it's like the earlier flights. One of the flights is like 6 a.m. and I was like, oh, I can't do that.
6 a.m. going there or 6 a.m. coming back?
Going there.
Yeah, okay, cool.
So it's like a 4 a.m. wake up.
Yeah, that's hard. That's hard.
But for $106.
Yeah, I mean, it's worth it, right?
Yeah.
And especially if you're going with other people, you know, if I were to take the rest of my family, it makes it much more affordable.
Much cheaper.
They just might be exhausted on the plane. So.
Yes. But I've always thought Webjet was more expensive. I didn't realize they had like sales this good.
Yeah, that's great. I like, where did you find the sale?
There's this guy on Instagram called Savvy Not Stingy. And he's on TikTok as well. And he just shares like travel deals.
Yeah, beautiful.
And he just posted a story being like $100 off Perth flights. And I was like, what? $100? I've never seen like $100 flights from Melbourne to Perth, apart from when Rex did it, but then they went bankrupt. So exciting.
So you got a flight for yourself?
Yes, my friend's getting married next year. So I booked it for like later next year.
Oh, good. Yeah. But that's great. It's such a great thing when you hear a tip like that. You can take advantage of it, especially if you know something's happening in the future. Yes. I love that. I used to always try to book awesome deal flights like back in the day before kids. Yes. But now it's just a little bit harder. You got to do a bit more planning. So yeah.
What's yours?
So I was thinking about this morning as I was getting ready. So we're coming here, we're getting ready, we're going to be on a podcast. I'm like, I kind of have to do my hair, kind of have to put makeup on. And over the last year specifically, I've gotten so many gray hairs. And a lot of that was due to family life, health issues, writing 2 books, like the whole works.
I feel like I can't notice it.
Well, there's
some people I feel like you can like, it really, especially with darker hair, sometimes I feel like you can notice it a lot, but yours, like,
it depends where I part my hair. And like on the side here, there's like quite a bit of grays happening.
Oh, yeah.
And honestly, I'm just embracing it because I think so much of just social media and media in general and consumerism is you have to look younger. You can't age gracefully. You need to dye your hair. You need to look after your wrinkles. You can't have cellulite. You can't have all those things. And honestly, I'm just here to be like, be you. I'm going to age gracefully and I'm here for it because it saves me money as well, right?
Money and time.
Money and time. Yeah.
I can't like all the appointments and stuff, like not that I get Botox or fillers or anything like that yet, but even just like going to get my eyebrows done and then booking an appointment if I want nice nails. Like it adds so much time as well.
So much time and so much money. And research shows that unfortunately women do have to put in time, energy, and money to kind of influence the way that they look, because if not, they get passed on promotions, they get passed on the opportunity to take on new roles, and they don't get taken seriously. This is unfortunately fact.
Yeah, worth going to have a Google if maybe your brain goes, oh no, I disagree, that's not true. I was reading a book recently that was kind of touching on like how people view people who look more attractive as more trustworthy and more friendly and more likely to succeed, which is really interesting. But there's all kind of studies you can read about that and the biases to do with that. But a great point to bring up for sure.
Yeah, because it's hard, because a part of me wants to age gracefully and embrace it and be like, I'm cool with my wrinkles and my gray hair. But the other side of me is am I going to miss out on opportunities? Am I going to miss out on things that will enhance my life in my career? So
it's just hard on social media these days when you're bombarded with like everyone's doing it. It feels like everyone's doing it at some points. And you're like, oh, but should I then? Like, is this really an issue now? And if you post videos of yourself online, you're a lot more aware of how you look and how I feel. Yes, some very unflattering angles we get filmed at sometimes.
Especially like when you're looking one way and then you flip it and see the way that you actually look. And you're like, oh my God.
I can't film with my back camera. I don't like it.
Yeah, it's so bizarre.
Oh, well, back to like the exciting world of ETFs first, LICs. I know you say LICs, but I like to say LIC.
LIC, yeah. I don't know. LICs is always what people said. Should I say LICs?
No, say LICs. We can both say them.
Can we say ETFs?
Oh my God.
For ETFs, that was a bad joke.
My friend was like, what are you saying?
Yeah, ETFs.
Yeah, no. Have you bought a LIC and LIC?
I have not. So when I first came to Australia and I was looking at investing in Australia, there was a big hype around ETFs and LICs. And I was trying to understand the difference because we didn't really have something like that back in Canada and I couldn't find the equivalent. But, you know, Australia has its own rules around franking credits, around, you know, tax breaks and so forth. So I had to dive into it. And I realized that a lot of people were investing in them because of the structure of them, because of the dividends that they were getting back. So there were benefits there. But I did not decide to go down that route because of everything that I understood in terms of having a diversified low cost index fund, which is why I went the ETFs route. What about you?
Yeah, same. I've only bought ETFs because I've never really understood LICs properly. And I don't know if I'm missing something, but I feel like there's less transparency and it's kind of like you're picking a more actively managed fund. And back then it was all like passive index ETFs, like don't pay extra for active management, don't pay extra fees. And like there's less transparency in what they're investing in some of them as well, which can be harder. So I was just like, oh no, not for me. I'll just stick with ETFs because like, why not? They're so cheap. You can see what's in them. Like it's not being muddled with humans, but yeah.
But there might be a reason why people would be interested in them.
Because I did see Scott Pape recommended one of them in one of his books early on.
Oh, is it still in the earlier versions of the book?
I think, it's in the version I have, but I think it's been removed now. But he recommended to put $5,000 into AFIC. And back then I was like, what? Like this is so specific. Why $5,000? Why AFIC? Like what is this? And that's kind of opened my mind up to what like LICs even were. But no, I decided not to do that.
Well, let's dive into it.
Yes.
Let's do a comparison.
So ETFs, what are they? Let's define them.
Exchange-traded funds, or ETFs, are investment funds that track indices, commodities, bonds, or a basket of assets. They are traded on the exchange, and the primary allure of ETFs is their ability to offer diversification, low fees, and they're just really easy to trade.
So they are a basket of shares that are traded on the stock exchange, but LICs, or listed investment companies, are a type of investment fund structured as companies and listed on the exchange. So instead of buying an ETF, which is a basket of shares, you actually invest in the company, which then their whole purpose is to buy shares. They typically have a closed-end structure, meaning that the number of shares in the company is fixed after the initial public offering. LICs are managed by professional investment managers who actively select and manage the investments.
So there are some similarities between the two. They're both bought and sold on the exchange. They're both usually low cost. There's a certain level of diversification, and often they're referred to as a basket of shares, but there are some differences.
So we're going to focus on like the structural differences for sure, but it's also important to point out that ETFs can be actively managed as well. So it's not just a thing that LICs can do.
Yeah.
So let's start with the differences between structure and management. So LICs are closed-end funds, meaning they raise a fixed amount of capital through an IPO, initial public offering, and then list on the stock exchange.
So after the IPO, the number of shares in a LIC does not change. I keep saying LIC, but LICs, sorry. Yep. Investors buy and sell shares on the share exchange.
As we just said, LICs are, you've changed me, LICs now.
LICs,
LICs. It's easy to say. LICs are actively managed. The fund manager selects the assets, so the stocks, the bonds, whatever else, and aims to outperform a benchmark index.
And they're structured as companies. So LICs often have a board of directors and they pay dividends from the profits or the income generated from the underlying investments.
Let's talk about ETFs now. ETFs are typically open-ended, meaning the number of shares can change. New shares can be created or redeemed based on demand.
And ETFs are traded on the share market, just like LICs, but they are usually passively managed, tracking an index or a specific sector. Now, yes, there are some ETFs that are actively managed, but predominantly, or the ones that we usually talk about, are passively managed.
ETFs can distribute income, so they pay dividends directly to investors based on the performance of the underlying assets. So we talked about structure. Let's talk about the differences in liquidity and price. So do you want to start with the LICs?
Yes. So the LICs share price are determined by market supply and demand. And this means that the LICs can trade at a discount or premium at their net asset value. So that's called a NAV.
The liquidity can vary depending on the size of the LIC and the investor interest, leading to potential price fluctuations that differ from the actual value of the underlying assets. This is, I think, one of the downsides for me. It can be a positive, but if you're paying more than the actual shares are worth, like that feels not ideal.
Yeah. So ETFs, on the other hand, are designed to closely track the NAV. So again, that is the net asset value of their underlying assets. And the process of creating and redeeming shares helps keep the ETF's market price in line with its NAV.
Because of this structure, ETFs generally trade close to the NAV, making them more transparent in terms of pricing.
They tend to have higher liquidity, especially those tracking large indices or popular markets. So what that means is that it's just easier to buy and sell them.
Yeah. So with LICs, it's kind of like you need to be a bit more actively involved as well. Like it's harder to, you can dollar cost average, but you are probably more concerned with the actual price of it and when you buy it and how closely it's tracking to the NAV. Whereas ETFs, you can kind of just dollar cost average in without having to worry like how much the fund is actually costing you at the moment.
Yeah.
Investment strategy. LICs are more suitable for investors looking for long-term exposure to actively managed portfolios.
And they often focus on generating income through dividends and can be appealing for income-focused investors. So that's one of the biggest appeals, I think, that I've understood from LICs is essentially the ability to potentially generate more income.
Mm-hmm. The active management can potentially lead to higher returns, but it also comes with the risk of underperforming compared to the benchmarks.
And Australian LICs are known for their focus on regular dividend payments. So I've already talked about this, but they often are accompanied by franking credits, which can be attractive for income-seeking investors because franking credits provide you a bit with a tax break.
Mm-hmm. A nice tax credit.
Yeah.
ETFs are generally preferred by investors seeking cost-effective, diversified exposure to a specific market segment or index. So you could be thinking like US or Australia or a specific type of market.
And they're often used for just passive investing. And that's kind of what we do as well, just for the long term, passively, because they track the indices or the sector.
ETFs typically have lower management fees compared to LICs or LICs, which can make them a cost-effective choice for long-term investing.
So when we're talking about fees, they're quite similar, but generally, LICs do have a higher management fee due to the fact that it is actively managed as opposed to passively managed.
And passively managed funds like ETFs, but also LICs can also come with performance fees if the manager does manage to outperform the market.
So that's just something to be aware of as well when you're looking at fees.
ETFs usually have lower management expense ratios. You may see these written down as MER or MERS because they are passively managed. This means they don't need to pay a human a salary to sit there and make decisions.
It's really confusing, actually, when you think of all the acronyms when you're thinking about investing and all the different fees that are associated, because you might not be thinking about everything that's linked to the cost of owning an asset, right?
Mm-hmm.
Yeah.
And when you're looking for like the dividend yield or something else, then you see like a MER written down and it's also an LIC and it's like, wow, there's so many letters.
Yeah. And then you have to kind of do the math, like what's that percentage plus this? And similarly, that's kind of when you look at super funds as well, right? You might have different fees that are associated and you might just look at one and then there's the fine print. I know I was trying to look at my super a little while ago. I'm going off topic here, but I realized that how much is hidden in the fine print of trying to find all the fees when you're doing the math.
I was deep diving on a few other brokers recently and it was interesting seeing them. I think we might have discussed this before, but like some write things in percentages and others use basis points and they try and confuse you because then you have to do the conversion in your head. And you might like miss something because you're like, oh, but they said percentages before, but now they actually mean something else.
Yeah. So for anyone who's like, what is a basis point? What is a percentage? For example, 0.50% would also be 50 basis points. So yeah, if you can imagine that 0.50 is 50 basis points or...
And then we'll use them interchangeably.
Yeah. And they get confusing. And then there's other things like if you're foreign exchange fees, right? And that's on top of something as well. And you have to do math. So
and some are in Australian dollars and some are in US dollars.
Yes, just to keep things interesting.
Fun.
Confusions.
So in summary,
ETFs equal passive, they're low cost, they're more liquid usually, and they closely track their NAV.
Just a quick reminder again, you can get active ETFs. So ETFs aren't always passive, but mostly are. LICs though, they are often active, potentially higher costs. You can possibly get them at a premium to pay more for them or get them at a discount, which can be an advantage if you can time that well. And they may be more tax efficient for long-term investors.
Yeah. So overall, it seems as though if you want to potentially have more income coming in, more dividends, you want to take advantage of franking credits, potentially LICs may be more suited for you.
Yes, but then you can get franking credits in like ETFs as well, or dividend-focused ETFs. I think it's looking at like the type of management structure you want and thinking, can this company actually outperform and give me a better return than a passive index ETF?
Mm-hmm. So there's two examples of LICs that I often see getting thrown around because they are the biggest ones. There is Argo Investments Limited, and that's traded on the ASX as ARG. And then there's the Australian Foundation Investment Company, which is traded as AFIC.
I've never heard it said as Australian Foundation Investment Company. I've always said AFIC in my head.
Oh, AFIC,
like, oh, yeah. No, they're great saying
it's like LICs and AFIC, AFIC.
When you know the acronyms and you don't ever like think about what it really stands for.
I guess that's the other thing. If you talk about something and you hear people talk about it as opposed to you read it for the first time.
Okay, so the two popular ones. Tell me more about Argo.
So Argo Investments is one of Australia's oldest and largest listed investment company, and it has around 90 Australian listed companies that are included in its portfolio. In financial year of 2024, the fully franked annual dividend was 34.5 cents per share, and Argo has approximately 93,000 shareholders. Its management expense ratio is 0.15%, and Argo was established in 1946 in Adelaide. So there you go.
Interesting. I was trying to find the returns of AFIC to just quickly mention them in this episode. I hoped it would be like ETFs where you could just get a fund number and be like, great, it's returned 20% over 2 years, whatever it is. On their website though, they include the returns with the franking credits and they assume that you can take full advantage of the franking credits. So it's not actually the return that you're getting. It feels like they're kind of skewing the results with how they display them. Because franking credits depend on your
marginal tax.
Yeah.
Yeah.
Interesting. Because I feel like they should just leave it and then like maybe do a separate one that says this is if you take full advantage of the franking credits because it's different for everyone.
I guess this is where it comes back to the financial literacy, actual literacy of how clear it is when you're looking at fees, returns, or understanding how things work, right?
Yeah, because it's like, oh yeah, that's like they've had decent returns over the long term. But then I read the asterisks down the bottom and I was like, oh, okay, because they're assuming you've made the most of those franking credits, which isn't the case for everyone.
Well, if you're a retiree, chances are you would probably get fully franked credits, maybe. Yeah.
And interesting how they tell you like, oh, this is the dividend we made, but then you have to go do the maths yourself. Like it's not telling you a percentage.
Yeah, that's always challenging. Maybe if they have a PDS, it's worth looking into, but we didn't get the chance to do that for this episode. So.
No, but I really admire and appreciate transparency. And I enjoy when you can see a table and it's got percentages and it's got the numbers and they're giving you like the actual real numbers. And then later on you can be like, sure, if you took advantage of X, then you might get this. But yeah, I don't like when you have to look really hard to find out what's actually going on.
Yeah, because it takes forever. If you and I, who understand what we're looking for, can't find it in 5 minutes, then it's not transparent. Or at least that's how I feel.
Yeah, and I don't want to have to go through a PDS to figure out what they mean really and what the hidden fees are. So I'm a bit disappointed that they have kind of skewed data in their favor. But that's marketing.
I was on a call with a financial advisor and I was talking about how my super was so hard to find the fees. And she's like, really? Like, let's try. And we were like on the call for like 8 minutes trying to find it. And we're like, if two people who work in the industry cannot find the fees, how do you think the average person is going to understand that?
Yeah. And why are we having so many different components to it? Like, why are we not being more transparent with it? Being like, this is the fee. Like, don't have like $1 fee and then like also have a percentage fee. Like that's so hard to work out for people.
Yeah, for sure. So in summary, I think we've dived pretty deep into LICs and ETFs and the differences between them. And I'd love to know if anyone who's listening, like, let us know, do you invest in LICs? Why? What do you like about them? What do you not like about them? We'd love to hear from you.
Yes, we'll have to get someone on as well. So, you know, an LIC expert, let us know, because I feel like we are both a bit more biased and we like ETFs. And I've kind of approached it with a mentality of like, what's the point? But we'll definitely get someone on to kind of give the other side to it as well. But I feel like we've given a nice comparison.
Yeah, I think like the franking side is really important. The dividend side is really important depending on where you are. And if you are looking to have income coming in, chances are of maybe you have low income or you're retired or any of those, that might be a better option.
Yeah, especially if you can buy an LIC at a discount, because that seems to be one of the main perks is you can get it trading at a discount, which you can't get with ETFs usually.
Yeah.
Amazing. Well, fun. Bye.
Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invests or me at Ana Cristina.
This show was brought to you by Natasha Etchman, who is an authorized representative 1299881 of Guideway Financial Services, AFSL 420367, and Perla, who is an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. Knowledge is power, especially when it comes to investing. So make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info.